question. So for the people who are a little bit less familiar with mezzanine, can you explain to them like what mezzanine capital markets is, or what are mezzanine investments, and how, like, the type of work you were doing? Just because I think people have heard the term, but not everyone knows what it is.
So, my mezzanine career tracked both the sell side and the buy side. So on the sell side, it's what you might imagine in terms of, I was in a capital markets group. What does that mean? Really, our role a little bit different from origination, in that it was our responsibility to generate the relationships with the actual purchasers, the investors of the mezzanine debt and equity, on occasion, securities that were being originated by our coverage groups.
Right.
And so, not to get too basic, but the way that we thought about mezzanine, especially private, were the gap financing in lower middle market deals, such that a mezzanine financing could be anywhere from, in our group, from $5 to $7 million all the way up to $50 million. But basically filling a hole among private investors versus the bigger public institutional, or I should say, between the bigger institutional dollars that were buying leveraged loans and high yield bonds. So these were private, more privately negotiated, bespoke or one-off type financing opportunities for those type deals.
And back then, did most of them have like equity kickers and warrants attached to them? So if a certain valuation was hit, that they would convert to equity, or they could convert to equity, or a small percentage?
So the answer to your question is we structure them as their debt securities with equity kickers. So in other words, with equity warrants attached, such that because if you think about a capital structure, there was some contractual return, but a lot of times these lenders were taking a hybrid of debt and equity risk. So they would price in some of that equity risk by taking a certain percentage of the company's equity, oftentimes anywhere from a point to 5 to 10%. Rarely do we ever see it up at 10, but 5 is pretty average.
Yeah, 1 to 5 is what I had seen, at least back in the day when I was interviewing for a mezz fund way back in the day.
Yeah.
But so
exactly.
I'm curious, the way I should think about this. So when people were structuring these debt securities with equity or warrants attached, those equity or warrants, was it typically something where it would convert no matter what, or only would convert at a specific valuation, like on a financing event? Or just it converted after a certain amount of time? Like how are they typically structured? Because I think myself and the listeners might actually learn something from understanding how those are structured. And if you know how they're structured today, have things changed on that at all? Do you know?
So I think that it's been fairly consistent with a warrant. So warrants are detachable. In other words, they can be detached from your bonds and traded independently. And really, what is a warrant for equity? It's really a long-term call option on the equity of the company.
Okay. And
it's your right, not your obligation, to convert to buy equity and have that. If it goes public, obviously there's a market for your securities.
Right.
And you can structure warrants however you want, and the way that ours typically were, one, they were detachable. Two, that they were cashless exercise. In other words, you didn't have to pay to exercise your warrant. They were pennies.
Almost more like restricted stock or something like that.
Almost.
Yeah.
Almost. They were unregistered.
Yep.
But on a change of, let's say there's a change of control. It's the easiest example. Company gets sold or acquired. Your warrants immediately vest or convert, or you can redeem them into the amount of the equity that's stated on the warrant. And so
that makes sense. And what about the underlying debt portion? Did the interest rate, was it typically higher than a subordinated note, like a unsecured bond, or was it because it had the equity upside? Was it priced typically under that? Do you remember around? Was it like 8 to 15%?
These things were fairly typical. Structure would be an 11 to 13% cash coupon on the underlying debt, maybe 1 to 4% PIK, payment in kind.
Yep.
In other words, you just get paid in more bonds. At the time, say there was a 1-year non-call period, then some sort of call schedule after a year or after however much time. Typically, on the buy side, we structured at least 2-year non-call with some sort of make-whole provision in the meantime. If you really had to redeem these ahead of the call schedule, there was a mechanism for that. We as investors, you want to know your money is tied up for at least a minimum amount of time before it gets called back or redeemed or repaid. Because if you're going through the effort to make the investment, you want it working for you
at least a couple of years or something. Yeah, that makes sense.
Otherwise, the reinvestment risk of having to redeploy that capital if it comes back too soon or it comes back quickly to find another
opportunity.
18 to 21% return is
very hard.
Difficult.
Yeah. So you're saying that a mezz lender could potentially get 11 to 13% cash coupon plus 1 to 3% PIK, payment in kind, meaning it's getting rolled back into the balance of the thing. So it's really almost like 15 to 16%. Plus they could actually have some warrants detachable warrants on that piece of paper. So it's a pretty expensive.
Yes, exactly.
It's pretty expensive financing for a company, correct? And it should be what kind of companies would do this? Like, why wouldn't they just go get a secured bank loan? Maybe they don't have enough assets, but is it typically because a bank won't give them a loan, or what's the situation here? Distressed?
Yes, it's an expensive, quote unquote, relative piece of paper compared to debt. It's always going to be cheaper than equity. Is what the way to think about it is that if you're raising $20 million in financing, and the dilution from having to give up, say, a 5% warrant versus a $20 million equity direct investment is significantly different.
Right.
But why are companies raising mezzanine capital? A few reasons. One is that there's an active market of investors purchasing these kinds of or investing in these kinds of securities, so that there's going to be some liquidity for that hole in the capital structure.
Yep.
Oftentimes banks, so the way that we thought about the capital structure is you get a certain amount of leverage through the traditional bank market. And there's going to be, if it's a buyout, there's going to be an equity component in that. But to fill out the capital structure, in other words, to get all the cash needed for an acquisition, you might need to fill it with what's now or what can be is mezzanine debt. And
do you feel like that's becoming more common because leverage is so high on these buyouts right now that where people are trying to write, people are buying companies at 12 to 15 times EBITDA, and it's, they're getting 8 turns of like senior debt, or is this something where it's becoming more common? Do you think?
Well, I think that where it has become more common,
lower middle market,
is that the middle market for sure. But how has the mezzanine market evolved? Rather than it being strictly basically a private high yield debt security, now what you're seeing are more creative senior financing, second lien, last out. Senior financing to help fill that financing potential financing gap, but with more senior paper because a lot of CLOs, a lot of investors have or credit funds have the dedicated dollars or have an entire strategy built around senior financing with a little bit of yield. And how do you get that? It's in these other creative securities or creative financings that fill the same role as mezzanine, but maybe from a pricing standpoint are a little more competitive. In other words, LIBOR plus 10, LIBOR plus 9 versus a straight 11 to 13% cash plus PIK plus equity.
Yeah.
You can still get your $20 million whole filled,
Yep.
but at a more cost competitive potentially.
Okay.
It doesn't always, it's still leverage. It's still debt.
Yep.
So you're still maxing out the cap structure to some extent.